Yes. What's going on, family? What's going on, guys? Welcome to today's stream as we are going live for the actual Fed funds rate decision. Also, in my opinion, more importantly, also going to be, taking a look at the economic summary of projections as well. So it's going to be a very interesting session, family. We're going to go ahead and dive deep into a lot of the data and pretty much come up with a bias or some type of a consensus overall that can really give us some insight for sure as to what the Fed plans on doing, and in return, gonna cause us to figure out also what we should be doing as well, right? So we're gonna go ahead and get started, guys, in just a few more minutes. We'll go ahead and get this thing on the road, right? So in the meantime, in between time, let's just chill out, let the rest of the team get on, and then we'll go ahead and start our thing, guys, and do what we do best, which is give you guys the most credible data that we can potentially give you guys for sure. All right. So we're gonna go ahead and just vibe out for a couple more minutes, and we'll get this thing started, family. Let's get it.
All sound production. All sound production.
Hold on. Let me know if you guys can hear me. Hello, hello, hello. What's going on, family? Y'all should be able to hear me now. What's good? Let me know in the chat if you guys can hear me. Oh, I know you can. 'Cause I can hear myself on the stream. But good evening, or good afternoon, more or less. I'm saying evening over here like it's 8 o'clock, 9 o'clock at night. It's middle of the day. But what's going on, family? Let me see who we got in the chat. We're getting ready for the Fed interest rate decision, FOMC expectations. So let's see. We got Nikayla, AJ, Easy Pip, Sniper, Leon, Saucin, Arturo, the boy Devin in the house. Chinchaka, what's going on, bro? EU took you out. I don't even know what EU is doing or whose EU trade you were even in, but we could take a look in a second. But what's going on, family? How's everybody doing? Let's see. Brandy Trader, what's going on, bro? Greg, good to see you all here. I know we in the middle of the day. I know some people working, family, but we're here to give you guys our little viewpoints on FOMC interest rate decision. Again, this news is dropping in about 15 minutes. Highly anticipated news. So I'm gonna give everybody another like minute or two to kind of get on. And then I'm gonna share my screen and kind of just go over some of the stuff that we're looking at. Again, we may take some trades, we may not. It all depends on what this comes out as and what kind of opportunities we see. The market definitely seems like it is continually pricing in that 50 basis point hike. So again, things like EU are moving up. You guys could see NASDAQ on the screen moving to the upside. Right, and this is all in anticipation of the Fed actually getting less aggressive on their rates and pricing in a 50 basis point hike. So definitely some interesting stuff going on. You over there in India, sheesh, was it there midnight there? We appreciate you joining us, bro. Elijah, how you doing, bro? Feeling blessed? I'm feeling blessed as well. Just had some good lunch. Now we're ready to kind of get the day going and see what we have here in the markets. Tammy, what's going on? Good to see you. So let me see if I can share my screen real quick. Because I do want to go over a few of the fundamentals before this news kind of pops off. So let's see. Share this. Beautiful. We'll just close that out. All right, so what you guys should see, well, first off, let's start here, right? Let's just take a look at some of the stuff coming out today. Again, we have about 14 minutes here until the interest rate projections, the FOMC statements, and the Fed interest rate decision. So again, widely expected that we go from 4% to about 4.5%, which is again a 50 basis point hike. This is going to be, seen as bearish for the dollar because it just means the Fed is getting less aggressive on their interest rates, although we are still raising them, right? Interest rates are still continuing to raise here, but we're lowering the amounts that we are used to having them raised by, right? For the last couple of interest rate decisions, we have had, 0.75% rise. And now with the Fed kind of easing off that gas, you kind of start to see, bearish momentum come into the dollar, or we start to see indices moving up, crypto moving up, right? Assets that people typically have flocked away from since we began to increase rates now start to see some strength again. What we're going to really be looking at is less to do with this because the market, again, is already kind of pricing this in, kind of already expecting this. This is stuff that we've been trying to prepare you guys for, or at least I have for the past month, 2 months. What we really want to look at is these economic projections. This gives us an idea of what the Fed looks to continue to do and what their target rate will be going forward for 2023, 2024. It is widely expected that they are actually going to increase some of these target rates. So if we kind of just take a look at some of these projections here, and what I'm going to do is I'm actually going to tab over to the Fed's actual last report in, I believe it was September. Yes, the September one. So this is on the Fed's website here, federalreserve.gov. This is all the documentation from their past meetings. And the last time we got projection materials were back in September. So I did open up that PDF, and this is all of the data that we have from September. This kind of gives a insights to what the Fed expects to do, throughout the years, right? Through 2022, 2023, 2024, and 2025. It's basically just their longer term outlook where certain things will be, right? Change in real GDP, the unemployment rates, inflation numbers. We're going to really focus on this federal funds rate is really what we're looking at. We could either use the median, the central tendency, or just the overall broader range. I typically kind of look at all of them. The numbers are relatively the same on most of them. Again, 4.1 to 4.4 is the central tendency. And then the broader range is from 3.9 to 4.6. So again, relatively the same numbers. We're going to look to see if there's any changes between this September report and the December report that's about to come out again here in 10 minutes. And what is widely expected is that although the Fed is expected to kind of do this 0.5% hike, it is widely expected that they are going to, potentially change some of these projections for 2023 and 2024 from this 4.5 to 4.9 range, and from the 3.5 to 4.5 range to maybe something that's a little bit, higher than 5%. So depending on how these projections come out are really going to dictate what the overall trend after the news is going to be, right? Because we know all week long the dollar has been fading off, indices have been pretty strong again into this event, and now it's going to be the question is like, are they going to keep targets relatively the same? Are they going to possibly lower them, which is on the less likely side? Or are they going to increase these a little bit? And if they do increase this, it could bring some selling. Again, if they only increase this by 0.5% or so, we may not see the kind of sell side reaction that we would expect if they maybe pumped this up to 6.5%. But this is what we're taking a look at. So again, they will be releasing this in about 10 minutes in this December section. I'm going to either try to grab it from here or see if investing.com can maybe get it up before the Fed. Because to be honest, the Fed's a little bit slow on like actually publishing the website side of things. They're usually 5 minutes behind as to not like accidentally leak it or anything random like that. So no mistakes there. So we'll see if in either investing.com or the Fed gets it up first, and then we'll dive into those projections and see if there's any changes made. Now, in reference to charts, again, you guys know I've been mostly bullish EU, mostly bullish indices, but pending what happens here, I might make some adjustments. I am still in NASDAQ shorts from yesterday. They might get hit at break even. If they do, so be it. And EU, I have exited my hedges earlier today, and I will be looking to potentially kind of re-enter those. So what I'm going to see is if these central tendencies, these ranges jump above, if these hit somewhere between like 5.9 and like 6.5%, I'm probably going to look to fade the news. Anything different than that, I'm probably going to wait for some price action. But if these ranges for 2023 jump from 4.9 to 5.9 to 6.4, something like that, I'm probably going to look to fade the news. That's about the only trade I'd be looking at today. If we don't get that, if they remain the same, if they get lowered, if they only go up by 0.5%, I'm probably just going to ignore this and say, okay, my year's wrapped up. I'll come back next year and just let my trades continue to ride. So that's really what we're looking at here. This is a big kind of, release. It's really going to set the tone for the beginning of 2023. And to be honest with you, probably for the entire year of 2023 as inflation, again, continues to drop. You can currently see some of their inflation targets. They do think in 2023, they'll be able to get it down to 3.4% inflation. Again, this is a little bit unlikely because, again, you could see their 2022 targets of 4.4 to 4.6. We know that's not what core CPI is at. Core CPI is actually closer to like 6%. So they're already kind of like missing their targets, which is why I do think that they will extend this out. But we'll have more information in about 8 minutes. I'm going to just quickly tab over here and check out the chats and see what you guys, if anybody else has any different varying opinions here. So let's take a look. Can we drop chart links? You can't drop chart links in the chat here. You're more than welcome to drop them in the backside of the community, though, on ProfitSociety.co. So if you have your beta account on ProfitSociety.co and you want to drop it in the community, that's more than okay. I'll be more than happy to check those out. But in the YouTube chat, the bot will silence those links. So let me switch this over to my chart so you guys are not looking at like an inception type of type of screen there. Again, we are seeing EU continually pushing higher. We discussed this on this morning's call, how this was again continuing to build up liquidity here, which is a big reason why I exited my hedge positions, because I knew again pre or post news that we're probably going to continue to push higher. Again, I'm long-term buying this. And we're going to see again if the news gives us a trigger to continue to the upside based off the fact that the Fed will not be raising projections, or if we can get a nice, some nice reactions off of this higher time frame supply, which we're now, finally kind of trading up into. So yeah, big day. Again, we'll know here about in 5 or so minutes on what we're gonna do. I'm gonna just go take a look at NASDAQ while you guys maybe throw some of your opinions in the chat. What you expect? Yeah, this one's not really moving as nice. So it is possible that maybe this does just spike up into some of this inefficiency if they raise projections, and then we can kind of take a sell. But again, I'm not really looking to execute off of this as much as I am going to use this to plan out my 2023. So we'll definitely take a look at that. Show some love with the likes. Yeah, if you guys are going to enjoy the stream, if you at any point you get value, we do appreciate you guys smashing that like button. USD JPY, take a quick look before news. Yeah, a lot of this stuff looks like it wants to spike a little bit lower. Let me just get rid of some of these pointless lines that I have on my chart here that don't matter no more.
Yeah, buddy, I'm excited to see what this is about to come out as.
Yeah, I have I don't know. I'm really not trying to execute around this, to be honest. There's some stuff that's acting a little like EU's acting a little weird. It's a little stronger than it should be, I think.
Yeah, EU actually did stop me out as well. For anybody that was with me, it wasn't too bad of a trade, anyways. We did end up at one point we were up around maybe 20, 30 pips or so, But I told you guys I was going to continue to hold my position. I did just that, right? But I only risked around 0.5%. But now it's just a matter of seeing what it does actually happen next, right? Like, what is this? Like, what is it actually doing? Right? Because this thing is still gaining strength minutes before the actual release. So,
Yeah, the DXY hasn't even grabbed the liquidity that I want yet. So I do think
What's
what I would
funny?
really like to see is I would really like to see the news again, that 50 basis point hike push this stuff down. And then if the projections get extended, I'm probably gonna be taking buys. Because a lot of this liquidity is just begging to be wiped. And then once that happens, I'm gonna probably strike pretty hard to the other way. Unless they don't raise it. If they don't raise expectations, I'm doing nothing today. So again, we'll have to see. Only if they raise, guys. A lot of these are going to be the same, right? Gold is going to be it's going to be no different than EU. I mean, like this is again not pushing as strong. Maybe we fill this wick, and then again, depending if they raise those expectations, then we'll look to get into that trade. So yeah, it's really going to be this is about setting yourself up for 2023. If you're finding the need to have to take a trade right now before the news, you're probably gambling, or you're probably not thinking about this logically. That's just my firm opinion on that.
I feel like it's definitely playing with everybody right now. Especially the dollar. Still feel like the dollar with this news release. I'm still bullish on it, and same thing with EU. Maybe some of you guys that maybe got into some preemptive sells. I mean, it's okay. I feel like the market's just playing with everybody, and I feel like it will eventually do its thing and give us.
I wouldn't even say it's playing though, because the news itself of a 50 basis point hike is very bearish dollar. Like you buying EU is not in any way against the trend. So like, I wouldn't say it's really playing around. It's playing very logical. I mean, like the way that we trade, like we know there's liquidity buildup above here. So again, you guys fully should have expected this this to get wipes. I mean, just based off the ways that we trade. With liquidity concepts. So then again, you're getting a lower interest rate decision. So like all of this is bullish EU. It's just only if they raise those expectations are they going to send the dollar back into some possible strength. Because again, decide this fallacy that the dollar is bullish hasn't been correct for 2.5 months. So I really don't like stating that the dollar is going to continue bullish. It hasn't been bullish for some months now. So yeah, we'll have to see again. We have a minute and a half here. You guys let me know though in the chat. What do you guys think? Are they gonna raise expectations or are they gonna keep expectations the same? And it's okay if you don't know, but take a stab at it anyway. If that's the only way you get, better with fundamentals. But I'm gonna switch my screen real quick and see if I could pull up the important information here. Again, we are expecting these federal fund rates projections for 2023 and 2024 to potentially tick higher. But the immediate reaction probably should be bearish. Bearish dollar here.
Yeah, it's gonna be
For those of you
interesting to
guys
see.
that were on the New York session, I am also still eyeing that USD CAD. I'm pretty sure Abu might still be looking at it as well. Again, we will be live on here to see this outcome. It's coming out in about 45 seconds. And if there's any potential setups, we'll definitely let you guys know. So we've got about 30 seconds now.
Let's see. Yeah, no, well, Fed raises rate. Yeah, we know that they're gonna raise rates. That's again, they're not gonna not raise rates. We know that. We know that. We're talking about the expectations though. The expectations for 2023 and 2024. Again, you guys got to play the future stuff. This has been guaranteed. This has been guaranteed since the last CPI. This has been I told you guys that last CPI when we came to 7.7, it's like, okay, they're going to do a 50. That is confirmed. I mean, if they do a 75 right now, that's going to shock the market to all hell. So I'll eat my words there if that's the case. So they did 5.1. It's 5.1, 4.1, 3.1. They very slightly increased this about 0.5%. So yeah, this is again something that I'm probably not going to chase to the sell side. I just want to confirm that investing.com doesn't have their stuff wrong.
Yeah, so it came out at 50. Let's
Yeah,
see.
5.1, 5.4, 3.9, 4.9. Yeah, so it's only a 0.5% raise in expectations. So the market's probably going to see this as let's just see what the market is seeing. Let's see. So they raised expectations. This is not enough, I don't think, for me to chase any sell side moves. Let me switch over to the charts real quick. Let's take a look. Okay, yeah, EU is reacting to the downside. That's interesting that she immediately reacted to the downside. Let's see how she closes. What did Nas do? Nas spike up first? No, of course not. Why would she?
Let's see. I don't know. I'm trying to figure out why it was gaining strength right before. I feel like that strength gain that just happened right
Liquidity
before
grab.
was like a liquidity grab or just a
Yeah.
fake out more than anything.
Getting everybody hyped for the news.
Cause it took out my position.
We were just playing around with everybody.
Now, the market don't play around. The market's very logical.
I feel like before news, it likes to pump up and play around with everybody, take out liquidity, take out stops, and then make its intended move. I mean, obviously, I'm using play around as a metaphor,
I think that's honestly what probably just happened. Like they've seen so much liquidity above a lot of these highs in terms of like Euro USD. They're like,
I
yeah,
gotta say though, I don't know if which one is the new one? This is the new one. We have 5.1. I mean, this is only about a 0.5% increase, though. This is not gonna give me the push down that I want. I mean, we're reacting to the downside, which is cool because I have hedged my position on NAS and stuff like that. But these are not really, again, like I said, I don't want to chase it if it's not a 5.5 to 5 to like 9. This is only about a 0.5% increase. Let's just check. Did they change inflation targets for 2023? 3.2 to 3.7. Oh, that might be what it is.
let's see. What?
Yeah, so what I'm gauging from this is that again the Fed is again like I said on this morning stream, right? On this morning stream, I told you guys they're gonna have to raise this a little bit because they need to give themselves more room, right, to do rates. So now that they're expecting it to be 5.5, that and then we're at 4.5 now, that gives them, two more 50 basis point hikes in 2023 before they're at their quote unquote their central tendency. Um, and then again, even the range is still pretty low. So you're probably going to get some nice reactions to the downside just because of this, just because they raised expectations. But ultimately, what I would probably advise people to still look at is still looking at like long EU, long NASDAQ. Now let's take a look at the charts real quick and see where we can maybe expect this stuff to end up. Because I know I talked to you guys about, this being the idea, right? That we would probably come up, swipe a bunch of liquidity, and then we were gonna maybe tumble all the way down to 101. I'm probably gonna rule out 101. I'm probably gonna rule out 101. I don't think this is gonna have enough power behind it to sweep all the way down to here. So what I'll probably end up doing now is like readjusting my sell side targets to somewhere like this 104 level, which is like more moderate before we kind of continue up. And that's kind of what I had drawn here, but this is just, signifying that it's gonna go down, not really go up. Yeah, quite interesting though. I would again, this is why I hedged my positions because the obvious move was obvious. And then even Nasdaq too, like Nasdaq, I'm probably gonna just continue watching this 11,400, and I know we talked about like the potential of it filling all of this. I'm gonna say that's probably unlikely now. So yeah, don't get too caught up in the sell side, family. That's early 2023. We're probably gonna want to look to remain bullish on these things. Yeah, I'm getting a bunch of notifications now about the news.
Let me see. Let me see. Let me see.
It's don't really have much power behind it, bro. What are you thinking about this?
I don't know. Um, I don't know. Right? Because they did raise the projections, but ever so slightly. Like
Yeah, like
literally.
almost not even noteworthy.
Yeah, like ever so slightly. But I don't know. I'm still expecting continuations to the downside for Euro, NAS, and all these plays. Be honest with you, like I still truly think that we could see EU, and I mean, obviously it's going to correlate across the board, but I wouldn't be surprised if we see EU come all the way down to that 1.0 level. Like I wouldn't be surprised at all. Just
But
be,
based off of, but what are you basing that off
I
of?
mean, I'm
Is there
basing
like
off the data, like the data itself. Like, I mean, we already expected that 50 basis point rate hike. That's not a surprise. Again, even the summary itself is not nothing shocking. So I think the only thing that the market is pretty much just going to rely on now is just the fact that the Fed is still hawkish. I think that's still going to be holding a lot of weight. We are still raising rates. Now, obviously, this is the first 50 basis point hike that we've seen, but I don't think that's going to be enough to overall change the overall sentiment that we've been having this entire year, right? Like, yeah, we had a nice little correction over the past 2 months of the dollar, but that was needed, right? We needed some type of a deeper correction. I personally, this is just me, I wouldn't be surprised if after something like this, it does catapult the dollar to actually go back into that bullish sentiment that has been in this entire year. Because even though now we're seeing, what they're saying, we're seeing the data, now we're pretty much allowing, the Fed to actually go ahead and continue to raise rates, but, do it in a little bit more slower pace, but they're still going to raise rates. Like, what is your thought process with that? Because I don't know, because that's where I think we might be seeing a little bit of a difference in terms of how the market is going to react. Because as long as the Fed is still hawkish, which they are, I think the dollar is still going to continue to benefit off of that. Now, when they do a full pivot,
yeah,
then yeah, right. When they stop
I don't
raising
know. I
rates,
would.
that's when I would start to consider. All right, you know what? They stopped raising rates. Now we should see a lot of money flowing back into those riskier assets, right? That's how I'm interpreting it, at least. Like, where are you at, right? Obviously I heard you say what you had to say,
I'll be
but
honest with you. I'm on like the opposite side of that.
yeah. So we're both on two opposite
Yeah,
sides
I
of
just
this.
like because to be honest with you, like I mean, because you're not wrong, right? Like textbook speaking, like you're right on the money, right? Like, let's get that out of the way. Like, there's nothing fundamentally wrong with what he just said, right? Because yeah, as the Fed looks to increase interest rates, that is often seen as bullish for the dollar because it makes the dollar more, appealing to quote unquote hold, right? It makes indices and crypto and all that look a little bit, less appealing. Um, However, though, it's like it's like when you hit like a climactic event, right? They're not going to get any more aggressive than they've already been, right? Which to me is like a sign that says, okay, the worst has passed, right? For the most part. So like anything that brings this stuff down, I think is just short term. And I've kind of like explained this. Like I do expect like the DXY to get like one like last final like nice little pump. Like I get like I would love to like come take out this high on the DXY, right? Like I would love to come and play up in some of this inefficiency and like give me the opportunity to get back in like shorts. But like what you're talking about, like with this being like just a pullback that this needed to like continue completely
That's my
is
bias. That's
like
my guess.
yeah, like that's like the way you're explaining that is the way that I see this incoming bullish move is like the way that I see like this is just going to be a little bit of a pullback that gets everybody back on that train saying yeah the dollar's back, the dollar's back, the dollar's back, and it's going to get smacked to all hell once it clears the supply, and like that's just going to be the
I mean,
top because again like I don't see it getting any worse.
yeah, I mean, I agree. I don't think inflation is gonna get any worse or anything like that. But again, I'm thinking, I'm looking at how, and it's just from my perspective, how people are looking at the dollar. I don't think investors and traders are looking at the dollar saying, "Oh yeah, let's go ahead and jump into the dollar." Right? That's not what I'm thinking. What I am thinking though is that there's a fact that the Fed is still going to raise rates. Like that fact alone is still going to cause a lot of traders, a lot of investors to want to stay on the sideline because they understand how interest rates continuously going up is going to influence a lot of these assets across the board. So that's like the perspective I'm still coming at, right?
I think you're right, but when you say traders and investors, bro, you're talking about small money. Like, what
I'm
do you think
talking
the hedge
about,
funds
I'm
and
more
banks
so
are going to look
talking
at?
not even just I'm not talking small, I'm talking about even the hedge funds. I'm talking about the big boys because yeah, we're starting to see obviously, this, CPI go lower and lower and lower, which is great. But there's still a lot of fear. There's still a lot of uncertainty in these markets, no matter what is happening right now, right? We just went through a crazy, crazy past 2, 3 years. And I'm pretty sure there's still a lot of fear across the board for hedge funds to say, you know what, let's go ahead and start jumping back in, right? With all this uncertainty that's still lingering around inflation and how far we are still from where the Fed wants to be at, which is at 2.5%, 3% level. We're still far away from that, right? We still got 5% to go to get back to that level. The only way we're gonna get CPI back to that level is if we keep interest rates high. So even if they did pause, right, on how much they're raising rates, it's still gonna be high. Like nobody's gonna be incentivized to go ahead and take out loans and grab all this money because the cost of money is still through the roof, right? So it's just little
But
things like
somebody
that I
has to
keep in
be on the
mind.
other side of those trades, though, right? So if everybody agrees with that and everybody's like, okay, we're selling, then my question is, who's on the other side of that, and why are they on the other side of that?
I mean, it could be the people that are looking at it from your perspective, right? There's gonna be hedge funds that are looking at it
Yeah,
from
but
your
I think the people that are
perspective.
looking at it, yeah, I think yeah, it's a tough spot to be in because like you're not wrong on like you're not wrong.
I'm
It's
just
just I
looking at
have
it
a
from more of
feeling.
a logical, like thinking based perspective, where I think you're just looking at it like you always do, right? You're forward thinking, right? You're thinking like 10 steps
Yeah, but
ahead of
that's the way the big
everybody.
money acts, bro. The big money is forward thinking. They're not the big money is not like the big money again is looking at this from the percentage of like, okay, like yes, the Fed is going to raise rates, which may bring prices down, but they're willing to absorb that and take the risk because they're not playing
Are they really
the
though?
game of what's going to happen in 2023. They're looking at the game of what's going to happen in 2024 or 2025 and is the prices I'm looking at now a discount in relation to that, you
And I
know?
and I definitely get that, but I also look at it like, damn, a lot of these hedge funds been getting wrecked all year. Do they really
Yeah,
want to
I mean,
go
there's always,
ahead?
there's always, I mean, it doesn't matter how much money you
It's
have,
like,
somebody's always going to lose.
yeah, it's like, do they really want to start to take chances of entering back into equities just because we're at a certain level right now,
Yeah,
even though they know that interest rates are going to remain high.
yeah, because that's when
I
the
don't
best
think.
pricing is. Because put it this way, bro, by the time it pivots, by the time the Fed fully pivots and stops hiking rates and starts, doing 0% or maybe even reversing, I'm telling you right now, by the time you flash that signal, it's going to be too late.
I don't know.
That's the thing. Is like by the time
I
by
don't
the
know.
time that the signal flashes, it's going to be too late. It's why I'm so bullish. It's why I'm so bullish crypto. It's because like again, like you might have this reaction today, but like wasn't telling you guys to buy it up here today. Like I do think that this is all seen as just heavily discounted pricing. Heavy discounted pricing. And I think big money is looking at the Nasdaq the same way. I mean, again, I could be wrong, and if I am, so be it. I could really care less. But I mean, like you're like literally. I mean, if you look at all this range down here, this is like pricing that you haven't seen since well, I mean, basically since like pre-pandemic. I mean, you can't say like 2008. That's much lower, but like nonetheless, that's. I mean, I don't know. We're gonna have opposing viewpoints, and we'll have to ultimately see who's like correct. But like, if I'm looking at this from like a technical basis too, like again, there's just a lot of selling activity that happened here, and we went nowhere. And then now the news came out, we saw more selling activity, and there's just even less selling activity. It just tells me that like these reactions are not big money. This is not serious selling. This is not the same thing as, moves like this where it's a high volume sell off. It's just not. So I don't, again, like, well, only time will tell. But like
That's
the
a
way you
fact.
break it down is like you're definitely 1,000% right. But I just know that the textbook answer isn't always the logical market answer. But I'm not going to complain if these fall. Like again, like I do want them to fall. I do think EU. If she can close below here, she can maybe fall. Right now, she's kind of just again like there's no follow through. These are just sitting here, just a lot of sell volume that
I
we went
mean,
nowhere.
we also got to keep in mind the press conference is in 15
Yeah,
minutes.
yeah, that's too. We
So
gotta
I
wait for
think the
two
markets
thirty.
are really just going to be chilling until the press conference to see what Jerome says. Like what Jerome says is really going to probably influence what truly ends up happening because we can see the
I'll tell you
summary.
what though,
Yep.
I read an interesting thing on Twitter, and I wish I sent this to you because I wanted your opinion on it. But there was a guy that did an analysis on FOMC,
Hmm.
and he said that if you fade the direction of 2 p.m. 5 minutes before the announcement, that it has a 92% success rate on turning around. So this guy basically all he does, and again, I'm not like advising people to do this, but I'm just telling you what I read on Twitter. And again, like he had all the charts to like back it up and prove it. But he's saying like if the initial reaction at 2 p.m. is down, that at like 2:25, 2:30, when the FOMC speech goes live, that it has a 92% success rate in just turning around.
Hmm.
So okay, we'll see if that's right today. Because I'm just
Yeah,
gonna
that's
see if
interesting
that
for
guy's
sure.
just talking out of his ass or
That
not.
does happen a lot.
That would
Yeah,
be
it
a
does. It does happen a lot, and
that
that's what
would
I'm
be
saying.
an
Like, look at all this
interesting
sell
play.
effort, bro. We couldn't even break structure. Like, he literally couldn't even break below here.
I mean, that's still a 300-point drop though.
Yeah, I mean the drop is. I mean, it's irrelevant though. It's not strong enough to break the
It didn't
structure. I
break
don't care how far it
structure
falls.
yet,
But
But
who says
again,
it will?
we have to see what Jerome says, right? If
Yeah,
Jerome just
I
continues to
agree.
reiterate what happens, with what the summary of economic projections says, then yeah, we might not really see anything crazy. But you never know, right? Again, I think it was like two FOMCs ago, right, where Jerome was doing his thing, and then some dumbass reporter asked a dumbass question and completely spooked the entire markets because of the answer that Jerome gave. So it's gonna be interesting to see what type of, not even just what Jerome says, but even the questions that are asked, right, and his answers that follow those questions, because
Yeah, I
that's
think
what
I
really is gonna
remember
hold a
that.
lot
That
of
was
weight.
when we were. Was that when we were watching it live? And I was like, "Oh, the market's not gonna like that answer."
Yeah, exactly, right. So
Yeah,
it's
that
gonna be
was
interesting.
yeah. Again, I want these to pull back more. Don't get me wrong. I'm just telling you, again, like what I see, like this reaction is also like again though, if you're gonna go off the textbook definitions of things, this is not the right direction the market should have moved.
Yeah,
Because again, you saw a 50 basis point. That is they're become like yeah, they're still hawkish or whatever they are. But when they're getting less aggressive, man, it is often seen as an early pivot sign. The rumor traders like me will take the chance.
mhm.
And again, I would love for it to push below 11,400. I'm all for that. If that's what it wants to do, again, I'm not trading inside of this middle of this range.
Hell
Like
no.
I have myself from up here. If this wants to continue dropping, like so be it. Like I'm not gonna cry over that.
Hell no.
But I do think that like after this sell-off happens, that we definitely return bullish.
Yeah.
And if I'm alone in that thought, then I mean, you know me, I'm still comfortable either way.
I would argue that Skaggs does better when he's alone.
Yeah, exactly. So like the fact that everybody is disagreeing with me right now
um,
actually excites me to the like in my like I'm just so happy
but here's the thing. I don't
because
even think it's and this for me like it's not even me fully disagreeing, right? Obviously, it's just my expectations are a little different. You can call it disagreeing, whatever you want.
yeah, yeah, fair
But
enough.
I just love these like family again. Like I know we're having like me and Skies be having these conversations as if it's just us, like really, right? So I want to know your guys' thoughts on these type of not even the conversations on who you guys think is right or wrong, but just the conversation itself, just bouncing off these ideas, bouncing off, having this dialogue together, right? And just really just coming up with every single potential play. Like, do you guys like this type of value, or is it something that we should stop, right? Like, what do you guys think in the chat? Should we continue having these type of conversations where we're, even if it's differing ideas, continue to have these conversations or not? Like, is it beneficial for you guys more than anything? And I think I already know the answer, but I really just want to hear you guys' thoughts. Because either way, shoot, we gonna be able to make money regardless of what this market does. Like regardless, right? And even for some of y'all in the chat too, that do have a deeper understanding of fundamentals, right? And like I said, I'm always open, guys, to allowing people to come on the platform and have a discussion with us, right? So even some of you guys that do have, your own thoughts and opinions as to what to happen, maybe next release, we can allow a few of you guys to come on and also, speak your piece, give your thoughts and opinions, and we'll just go ahead and go back and forth and just really figure out what makes the most sense logically.
Yeah, let's see what we got in the chat here because I think we definitely missed a lot in our little
Yeah, we was going
friendly
back and
debate
forth.
there. Let's see. So somebody says we must see dollar to 107 and then melt to the downside. I don't even know what the DXY is at right now, but that sounds pretty much like what I see. My mind says we could keep pushing higher, but also this generation of investors are more savvy and in the know than ever. So I wouldn't be surprised if that means a sneakier Fed. I would. Think you're giving a lot of credit to the investors of this time. You just go on the Wall Street bets, and you tell me if you have that same opinion after reading around on there. Two legends speaking their mind, love it. Yeah, I mean, we just say again, we like Abel and I, and again too. You guys know me. I like to argue a point, even if I don't fully believe it. So sometimes I will play devil's advocate, just because it enhances the conversation and it allows us to discuss more things. And like, because if we just all agree with each other, then we just say that we agree, and then it kind of like you guys don't really get like the full discussion of everything that could be talked about, like all the what ifs, this and that. And
Facts.
that's why like you have to have those conversations with yourself too. That's why when I looking at this stuff, I say, okay, if I see this, then I'm gonna do this. If that happens, then this is kind of like where my mind's gonna be at. You can't just have one opinion and be done. So sometimes again we do this just to again enhance the value for you guys.
100%. And there's the thing too, family. Like, if I'm wrong, I'm wrong. I don't care. Like, that's the thing with me and Skaggs too. Like, we have no issues whatsoever going back and forth because it's never about a bragging thing for us. It's never about like, oh, I was right, I did this, and you were wrong. It's never about that for us, right? It's literally about two heads coming together and really just sharing our thoughts and opinions as to what can happen. If I'm wrong, so be it. Skaggs ain't gonna come back and say, "Oh, hey, well, you were wrong," da da da, and vice versa, right? If Skaggs is wrong, I'm not gonna be like, "Oh, bro, you were wrong. I told you." It's not about the "I told you so," right? It's about coming up with logical decisions around the data that we have available and figuring out what can happen next. And I think that's why it works out so good because we are so mature in that sense. We don't care about if we're right or wrong. We're just trying to, bring up some points, some valid points at that.
Yeah, that's a big fact. Abel, Jude said that I don't know if you were trading Euro AUD, but it's up 100 pips. I don't know if that's something you're in, if you're not in. But
he had called it out. That's his call.
Okay.
Yeah, so
I
big shout
feel
out
it. So
to him,
what the
man.
hell? Where's my signal at, bro?
Oh my, that thing is flying. You ain't tell me it was going like that.
Where was my signal, bro? You got people sending signals, and I'm not even. I feel some type of way about that. Just letting you know.
Shout out to that boy Jude, man. Nah, he been going
Yeah, that's a
crazy.
fact.
He's been talking
Yeah,
about
nah, I
EA since
mean,
yesterday, though.
yeah,
Literally.
no, I mean that's also one of the people that is always tapped in.
Facts.
Always marking up charts.
That's a big
Great,
fact.
great, great student. I mean, we have a lot of great students. Don't let me, calling out one discourage anybody else on the call, but we definitely know the people that are again, providing a lot of charts in the back end, coming up with their own ideas, really learning and applying it. Because learning is one thing, applying it is a different thing, right?
Hmm.
Knowledge and experience are not the same thing. You could be very knowledgeable with no experience, and you could still make a bunch of mistakes. So
Yeah,
for
that's
those
a
of you
fact.
putting in the time, past the knowledge and into the experience, we definitely appreciate you.
100%. Let's see. I see people say I left IM to come here. IM versus PS. Listen, again, I'm never gonna be an IM hater, right? I said this last night on my stream too, because I seen somebody started to throw shade towards IM, right? Which is a very popular thing to do on YouTube, unfortunately. But it's never a us versus anybody, right? I don't compare us against anybody, right? Just because there's no point, right? Like there's no value in that, right? So I mean, listen, shout out to IM. They're doing great things still, right? They've been a staple in this industry for, I mean, for as long as the MLM space been doing it. So again, it's never, you guys are never gonna get negative reactions out of us towards IM, right? And I know that's what a lot of people usually want. I'm always gonna show massive love because they gave me an opportunity to teach, right? They put me on stages. They allowed me to teach in 3 different countries, right? In hundreds of different cities, right? They allowed me to do that stuff. So I got nothing but love and respect for that platform.
Yeah, big shout out to the people that are doing it right over there. Always, always, always. Again, there's no hate, no animosity between anybody. We're not here for that. We're just here to provide value and trade.
That's a fact.
But I do gotta say, just on a personal level, I like to have Abel on my side. So
Now I'm definitely happy
that's
that I took
yeah.
my
I'll
talents to
just I'll
YouTube.
leave it with that. It's a loss for them and a win for me.
I'm definitely I'm definitely happy that my time with them ran out, you could say, and I took my talents over here to YouTube and the Profit Society. We have a lot of great things coming for sure.
All about learning and getting better daily, and of course making money along with it. Yeah, as long as you get better every day, the money will eventually come. It's just a fact of anything. I mean, the more experience you have, then the more probable you are to make money. You may not always make money. You're still gonna have losing days. Trust me, I still do too. We all do. Should I
Facts.
have losing days, losing weeks, losing months, and then I have months like my past 2, 3 months, which are some of the best months in my trading career over 8 years. Like from October till now, I've been on absolute fire. Now I know that that's probably going to slow down at some point, which is why I'm also limiting myself. But it's been great, and it's honestly great just to see some of you guys really tapping in with that.
That's a fact. I mean, we do got 5 minutes, family, for this press conference. So we're just gonna go ahead and keep on bouncing off these comments that you guys have. Any questions that you guys might have, now is the best time to do it before this press conference starts. If you have anything. All right, but let's see. Abel leaned into the mic and said, "I'm going to South Beach, right? Yeah, my LeBron-ish facts."
They're taking his talents also. I
Let's
love
see.
it.
Had to cancel my IM account because money is tight. I mean, it happens at Truro. It'd be like that. I know a lot of people that went through that. Mishopping on Lindor's lives. You know what's crazy? Shout out to my guy Stevenson too. He was actually live yesterday on YouTube. I'm not sure if you guys are aware of the fact that he goes live on YouTube. I don't even know if he goes live on YouTube all the time or not, but he was actually live on YouTube yesterday, right? So big shout out to Stevenson. Definitely one of my good friends that again is another dope ass trader. That comes from that platform.
Can someone please blow a kiss to confirm this is live? Is me reading this comment not like confirmation that it's live?
Yo,
I
Jay,
mean,
you
you
are
see, you see us
hilarious,
reading comments that are like right above yours in the chat.
bro.
But
Jay is
yeah, shout out to
hilarious,
you,
bro.
Jay.
Jay is hilarious.
Shout out to you, Jay. Oh man.
And I appreciate you, Jessela, for sending them that kiss too. By the way.
Yeah.
All
It's a fact.
right, so let's see.
That's hilarious.
Let's see. How is the market? I
Yeah,
mean,
markets are interesting coming into this speech though. According to that Twitter thread, you should be pushing the buy button right now. But again, let's let's not take advice from random Twitter
shit, I'm
threads.
about to do it. Risk 0.1% real quick. Hold on.
Honestly, if we had spiked below here and closed up, I probably would have pushed the button.
And he said for Nas specifically, I'll throw. You know what I'm saying?
Um, I think he was talking about the SPY specifically, but I mean,
Oh,
more or
S&P.
less the same thing.
So I'll check the S&P then.
Yeah, it's more or less than the same thing though.
Yeah. Let's take a
Yeah, the
shot.
question is, what am I gonna do with my sell up here? Because I mean, I could just move my stop loss here. That's not really my style.
All right, so I bought S&P. Definitely do not do what
Bro,
I
you
did
really
now.
you really gonna do that?
Yeah, hell yeah. Do not
I'll
do.
call, fine. I'll throw a little something on there too. I'll lose money with you.
Like, hey man, if this works out, we might have found a glitch. Shit, could be Gold Gap Part 2.
He says it's 92% accurate, which is the only thing that caught my attention. I was like, if you got the data to support it, and to be honest, that's kind of my experience too, especially like this. Like, this is not the correct directive move for that 50 basis point hike. It's quite literally not. And again, it's probably because it was mostly priced in, so the market was like, all right, cool, time to take profit on this.
Now the
Yeah,
next question I
we'll
got for
see if
you.
this theory works.
Now the next question I got for you with what you just said. Why would a 50 basis point hike make the market go in the opposite direction if you don't mind answering that?
In terms of like this, or the fact that we've been trending up all week.
I mean, just in terms of like the reaction that we just seen. Like
Oh,
why
that's just it's just priced in. Because again, like this is like the 50 basis point hike was not like this, unforeseen event.
Yeah, nah, it
Like
was
like
obvious.
everybody knew it was coming in, and that's again why all week, if you're playing the rumor, right, all week it trended bullish. That's why even before CPI it was already kind of moving up, because people knew what CPI was going to come at. They knew it was going to come out lower. They knew about the 50 basis point hike, so they're just positioning themselves early, and they're using that kind of fresh move here to like take profit. So like same thing here. It's like it comes out as 50, the expectations didn't really rise. There's no really unexpected news. So,
Mhm.
the algorithms, or the big banks, or whatever fancy word you want to attach to the people that move the market, just use that kind of as like a profit taking mechanism. And in this scenario, there really wasn't anybody, hyping the price up to the point that it, was able to kind of close higher. So it's just profit taking on what's called expected news, right?
Yeah.
So when you're looking at news, it's like, again, some stuff is obvious, some stuff is not, right?
Mhm.
So when you have a very obvious news event and everybody's trading in that direction all week, then the likely thing is, again, that it's priced in, and you're gonna get these like little dips, and you have to wait for like further data.
All right, Jerome
So
Powell is about to speak any minute now.
yeah, he is. I don't
Let's
know if you want to stream it. I usually don't listen to it. I usually just tap into like some Twitter feeds, but
I mean, I don't mind streaming it. But I usually do the same exact thing. I be tapping into Twitter to really get the key points.
did he have the data to support it, or is that an imaginary number? What are you talking about, Tom? What's that in reference to?
Let's see. You'll get burnt at 11,700. Shit, I'm about to get burnt then, Kosi. Shout out to Kosi too. Super active in the communities. Let's see. Gold Gap Part 2. Yeah, Silver Surfer. Rod, they don't know about Gold Gap. That was what a time to be alive back then.
Hold on, somebody wants me to check the community. Um,
He said after the stream.
oh, okay, fair enough.
Yeah, shout out to that boy Reap. Let's see. Let's see. All right, so he is live right now. I'm about to go
Details
ahead
of today's
and,
meeting, I'd like to underscore for the American people that we understand
All
the
right, fam. So
hardship that high
we'll see
inflation
what
is
Powell has to
causing,
say here.
and that we are strongly committed to
Again,
bringing inflation back
we'll
down to
have
our
to listen to the
2% goal.
questions and whatnot. This can be a little bit boring, but
Over the course of the
nonetheless,
year, we've taken
we'll tap
forceful
in.
actions to
watch
tighten the
the
stance of
markets to see
monetary
how he
policy.
reacts as he speaks.
We've covered a lot of
Just
ground,
so you know, if we
and the
can't
full
hear it on our
effects
side.
of our
Or, well, hold
rapid
on.
tightening so far are yet
Yes,
to be
we can.
felt.
Never mind. I'm sorry.
Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024,
Yo,
and
I do just want to let
2.1%
you guys know
in 2025.
CAD is coming
Participants
up to that
continue
entry.
to see risks to
I'm gonna let you
inflation
guys
as
know
weighted to the upside.
If I'm gonna go ahead and execute, I'm keeping an eye on it, and I'm not. It's not at entry yet. It's about like 15 pips away.
All right, let's get back to this.
But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if
Market's not gonna like that
inflation data
statement.
are softer.
Gina.
Marcus haven't liked anything he said so far.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more, And so it didn't go up by much in the median, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria?
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil?
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Kate.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy, so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time. The kind of thing that had to happen when inflation really got out of control, and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that, and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Okay, I think we've officially entered the stupid questions phase of this.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business.
I don't
As
think
you
he's got
monitor
anything
wage
else to
growth,
say that's worthwhile.
I was about to say the last guy that was from Bloomberg, he like tried to set him up to spook the markets. I mean, but yeah, family, again, like now we're just getting to very repetitive questions that he already answered overall.
I would go back to the labor
But
market that we had.
how has the market reacted so far?
Stay bearish dollar. He ain't say nothing that's gonna spook nobody. Like I said, we're closer to the end. They're pretty confident they have stuff under control. Is what I've gathered from this. I mean, EU's already running higher. Like people have realized that what he's saying is not strictly speaking going to be best for the dollar in the long term. There's like some slight risks. Like he keeps saying over and over and over. He's like, we'll have to. This is the best I can give you based off the information we have today. That's like maybe the most, speculative line that he said. Everything else that he said basically points to the idea that, again, like, even though they're increasing rates, it's the same stuff that we've been talking about. They're going to slow the pace at which they're increasing. They're going to remain keeping interest rates high. They're going to commit to that. They have to commit to that to get down to 2%. We know that they're going to have to remain high for a sustained period of time. They look to put it a little bit higher because, again, they have future rate hikes in mind. They had to open up that path. But again, like I said, because they didn't go to something like 6%, because they didn't wildly, change their expectations, a lot of this sell side stuff is going to get absorbed. So like EU is already pushing new highs. The Nasdaq is grabbed enough liquidity to probably go bullish again. Lagging a little bit behind, but he did say some specific. I don't know how the SPX and US 30 look, but he did say some stuff that's specifically negative for the Nasdaq in terms of like layoffs and stuff like that. Because again, tech is a little bit different in that field right now. Because all the headlines you've seen about people getting laid off is more or less in the tech sector. There's not, like he said, most companies understand how hard it is to hire right now, so they're not really trying to do anything, in which case they're like letting employees go. Like that would be like a terrible decision because you'd have a hard time finding people to replace them. So again, I get where people come at with them raising rates, and you guys think it's all going to be bearish and all that, but I'm really leaning towards the other way. I'm going to continue my bias that the worst is behind us, and unless data proves me wrong, unless CPI early 2023 proves me wrong, unless I get data that I know the Fed will have to act on, I'm still fully in support of bearish dollar, long indices, long crypto. And that's just where I'm going to be at for probably all of 2023 into 2024. I'm gonna be that annoying guy that's just against everybody else. And Powell did nothing but confirm that for me just now.
Yeah, I don't know. I actually, and again, I'm interpreting it a little bit differently. Like, even though the market right now is reacting, it really completely erased that entire move that we've seen. Because the one thing that I noticed that he said numerous times was, again, that they are not going to let up just yet. They're going to remain extremely aggressive on raising rates until they finally realize that inflation is at a nice way down, right? So, I mean, again, there's a few different ways to interpret what is being said here, but the market is clearly liking what he's saying so far, all right? And that's just one thing we can't argue.
Yeah, the market is going to see it as more bullish because it's just, again, like you're not going to get those 75 basis point hikes anymore. There's no reason for them. They're going to do 50. They might expand on those 50. That's great, But then when the market really turned around is when that dude asked him whether or not this meant that they were going to basically slow down and pause. And from that moment, from his answer, which again was they can only go off the information that they have, which is what he said, which tells me right away that as long as CPI continues to trend to the downside, we don't see like some sort of crazy 0.5% spike in CPI, that they're going to stay at 50. They're going to look to go to 25. So that solidifies it for me as like, again, the worst is behind us. Like, is raising rates bearish for indices? Yes. Does that mean in every environment where they're raising rates, does that mean you're going to get negative reactions? No, this is not what that means. Investors will often see that as an opportunity to get stuff at a discount, and that's the way I interpret it. So don't be surprised if you guys see me exchange my EU buys from like 107.50 TPs, which I'm about to remove right now, and extend my targets up to like 110, 111, 112, and look for like NASDAQ to clear 12,800. But everybody will trade their own way. But I'm letting you guys know right now, everything that he said only further supports my idea that the bottoms are probably in. And the more people that disagree with that, the more confident I'm probably going to end up being.
Yeah, nah, it's definitely interesting to see the market itself, how it's reacting.
Yeah, I took an additional NASDAQ buy because I had to hedge my. Yeah, I mean that was the only thing I really took, was just a little bit of a buy. So I basically put my risk back in on that NAS because I didn't close my sell just yet. But I added my buy, so now I'm in 4 positions, 3 that are buys, 1 that's a sell. And when the sell gets stopped out at break even, that'll be fine because again I've added a new position today. So yeah, I'm just very much still bullish, man. I don't see any reason that this stuff comes tumbling down.
It's definitely interesting to see for sure. I'm still, and again, this is me. I still would need to see this level completely cleared now before I change my bias. If we see a run of this 107 here on Euro, then yeah, at that point there could
you won't be waiting too long.
off, but then at that point
You
I'll
won't
be
be
like,
waiting too long, my friend. You'll see it tomorrow.
I mean, only time will tell. Tomorrow we might wake
Yeah,
up and
once
this thing is
tomorrow we'll take a look.
all right. Tomorrow we wake up and this thing is much lower. Then I'm gonna be like, my brother.
That's fine. Yeah, listen, if I'm wrong, so be it. But I'm telling you, I mean, like, listen. After we break that 107.50, like, can I see like a little bit of a fade off? Yeah, because again, like, I would want an opportunity to like, like that's just like there's a lot of compression happening there. So after the compression works out, we break above the 107 and we maybe test like 108. Yeah, maybe we'll get like a nice little pullback that we could re-enter in on, but.
And
I see very little reason to go against the way that I'm trading right now.
Like, I'm actually looking for positions to go short, if I'm being honest, being a little degenerate to what you're saying.
That's okay. Hey, listen, you're free to do it.
Yeah, only time will tell.
I wish you the absolute best, and I might even take it with you. But nonetheless.
We'll see what happens at the end of the day. See what the market gives
Abel,
us.
they said your volume's low for some reason. Let's see. Somebody said I'm stopped at a EuroCAD. I don't recall us giving a EuroCAD trade. I think Kyle's USD CAD went very well.
Let me see.
What's up with the CBDC? Why did they say nothing about that? What would they have to say about that? There's nothing new that they need to say about that. One that's not the point of the meeting. So like that's straight away, that's number one. They're not going to be talking about the CBDC at an economic projections meeting. That's literally not a part of what they're trying to do. There is no impact on interest rates, inflation, GDP, or job growth. So it has nothing to do with any of those things. They're not going to just randomly talk about the CBDC there. Second off, that's not scheduled until March of 2023, and it's still in the testing phase. So they have no reason to discuss
that's what I was about
anything
to say.
like that at this type of meeting. That's quite literally what they're not going to do that.
Yeah, I mean, they're still testing that out, so it's a little premature to try to give any type of data on that.
Yeah, they're not going to have a meeting to the public about something that they're still testing and not rolling out, till a few months into the new year.
And I'm pretty sure that's going to be a news event in itself, right? Because that's like a major deal, right? They're not going to just try to add
that's going to be a whole big thing.
Yeah, 100%.
Isn't it it is the future of the economy in the world. That doesn't mean that they're going to talk about it right now. Trust me, by the time they talk about that, I heard December they were implementing. No, you heard it wrong. March 2023. You can look it up. Go look up the article that says that they're doing that. Go just search CBDC 12-week test phase, It'll tell you March 2023 is the target goal for that going live.
Yeah, let's see. The New York
Now
Fed.
ISO 20022 technically goes live at the end of December, yes, but that's not. Again, you're talking about major infrastructural changes. It's not going to just be like, okay, cool, it's 2023, and just like snap your fingers and it's all fine and dandy. There's still people that can't even properly remember the passcode to their own phone. So they need to they need to slow roll that out for sure.
Yeah, I mean, you guys got.
And for the most part, a lot of that's going to be implemented on the back end before you see it on the customer side.
Yeah.
Like they're not worried about implementing that into you yet. They're first off, they have to get every single financial institution that's connected on board with the systems in the back end, and then they can start slowly working that out to you. So the Fed's not going to instruct you on that. Your bank will more than likely send you details on that.
Yeah, because again, they're still so early. Like you gotta understand how early we are. Like they're just now testing, right? They're testing with simulated reserves. Like it's not even real actual data except for just the simulations. They're
Well,
pretty much
it's
using a
I think
demo
it's
account. They're pretty much
is it not well, yeah, it is simulated, but is it not? I thought they were like
they're using a
I thought they
demo
were
account.
using the actual books, but just on like a test net.
Yeah, they're pretty much using a demo account, right? Just like how traders can get a demo account.
Yeah, but they're still
trade
using the
real
data
live
they're using
markets.
in that demo is from the actual market. I think it's the same information. It's just they're making sure that it translates over.
Yeah, same exact thing.
Yeah.
Yeah, demo account. They demo account trading right now.
Yeah, so that's a fact.
Yeah, but yeah, no, that's again, this is going to be a major talk. Probably, I mean, I don't think this is something that's going to launch not soon, in my opinion. Right? They still got a
Yeah,
lot
I know
of.
the target date's March 2023, but again, like this, it's going to be a slow roll for sure.
That's a fact. All right, so again, I did end up taking a degenerate sell all the way up here. We're gonna see what happens with this. See if I can catch this little fade off, if it does happen. Yeah, but besides that though, family, man, it's been an interesting day overall from this morning session to now. This just looking at the data, having the discussions back and forth, coming up with a solid game plan, solid ideas. I think it's been a very, very interesting day for sure. All right, you got anything else, Skaggs, before we get off this?
Let me just check chats. Guys, I'm guessing that tweet you've seen is right. I mean, well, the market pushed down much further. What I mean. So like, I don't know if I would say it was fully right because it said to buy it at 225, and if you did that, you probably would have had to hold some nasty drawdown. Again, though, the guy that did that posted that, he's also trading options, so it's a little bit different of an environment as well. For us CFD traders, we have to be a little bit more peculiar about the price that we enter in at, where the options traders are mostly trading off expiry. Yes, price is important, but their drawdown is visualized a little bit different.
That's a fact. Big fact.
But yeah, aside from that, yeah, no, I'm pretty good. Hopefully you guys got some value out of watching us kind of digest the news. We do this mostly to help you guys, advance on your fundamental journeys and just kind of like narrate, how we absorb the information and then how we go and apply that to the market. So yeah, hopefully you guys enjoyed this. That's all I really have. We'll see you guys on future sessions. And as always, we wish you guys the best. But yeah, that's all I got, man.
Yep. All right, family. We appreciate y'all. Love you guys, man. We will be back live tomorrow once again. New York session, same time, same place. Profit Society channel. Show up and yeah, just continue to gain the value. But all right, y'all. Appreciate y'all. Love y'all. And we'll talk to you guys later. Let's get it.